Welcome! Today we're getting into something super important, your financial blueprint. We're going to demystify portfolio management and turn what sounds like a complex topic into a clear, actionable strategy for your future. So let's jump right in.
All right, so you've done the hard part. You've actually managed to save up some money. That's awesome. But now what? Seriously, what do you do with it? How do you make that money start working for you? It's a question pretty much everyone faces, and it's exactly what we're going to tackle today.
And this really gets us to the fundamental challenge for any investor. It doesn't matter if you're just starting out or if you've been doing this for years.
At its heart, it all comes down to this one balancing act. You want your savings to grow, right? To build up over time. But you also want to be able to sleep at night without worrying you're going to lose it all. This isn't about throwing darts at a board. There's a disciplined way to solve this exact problem.
And that disciplined approach, well, it has a name. Let's get into the solution: portfolio management. This is the framework that takes you from making kind of random financial decisions to having a real, cohesive plan that's pointed towards your goals.
Now, what I love about this definition is that it calls it an art and science. It's a science for sure, because it's based on hard data, analysis, and principles that work. But it's also an art, because it takes real judgment to tailor a strategy that fits a unique person, you.
So what are we really trying to do here? It's not just about picking a few winning stocks. Of course, we want our capital to grow, but it's also about smart asset allocation, spreading things out. It's about minimizing risk through diversification. And maybe most important of all, it's about making sure everything, and I mean everything, is tied to your big long-term goals, like retirement.
Okay, I know this can sound a bit complicated, but you can actually break the whole thing down into a simple, repeating cycle. We're going to boil it down to 3 core steps that anyone can understand and follow.
And here they are: plan, build, and monitor. The most important thing to see here are those arrows. They show you that this is a loop. It's not a set it and forget it kind of deal. It's a living process that has to adapt as your life changes and, of course, as the markets change.
Everything, and I mean everything, starts with a plan. You wouldn't build a house without a blueprint, would you? So you definitely shouldn't be building a portfolio without a rock-solid plan. This is where you lay the foundation and define what you're trying to do and what your rules are.
Now, this acronym, RRTLU, might look a little funny, but it's basically your personal checklist for creating that plan. It makes you think about things like your risk tolerance. How much market craziness can you actually handle? And your time horizon. Are you saving for something in 5 years or 30 years? Answering these questions honestly is probably the single most important part of this whole process.
Once you've got all those answers, you make it official in what's called an investment policy statement, or an IPS. The best way to think of this is like your own personal financial constitution. It's the rulebook that guides every decision you make from here on out, and it's what's going to stop you from making panicked, emotional mistakes when the market gets a little wild.
Okay, so you've got your plan. Now it's time for step 2, the execution. This is where the rubber meets the road. You actually build the portfolio by picking your investments. Deciding the right mix of things like stocks and bonds, and then choosing the specific assets inside those buckets.
And finally, we're at step 3. You've built your beautiful portfolio, but the job is never, ever done. You have to monitor it. That means checking in on your holdings, rebalancing things when they get out of whack, and measuring your performance to make sure you're actually still on track to hit your goals.
So when we talk about how you manage all this, there's a big fork in the road. You've basically got to choose between 2 fundamental strategies: active management and passive management.
Okay, this table breaks it down really nicely. On one side, you've got active management. The goal here is to be a superstar, to try and beat the market. This means frequent trading, trying to time things just right, picking specific winners. And yeah, that expertise usually comes with higher fees. On the other side is passive management. This is a totally different game. The goal isn't to beat the market, but to be the market. You just try to match its performance, usually by tracking a big index like the S&P 500. And because it's way more hands-off, the costs are typically much, much lower.
I really like this quote because it just makes the whole idea click. It doesn't matter if you go active or passive. Asset management is basically like getting a coach for your money. They're using their expertise and the right tools to help you hit your financial goals, just like an athlete hires a coach to help them win. And speaking of tools, you do not need to be a billionaire to get access to them. Modern finance has come up with some incredible tools that make really sophisticated portfolio management something that just about anyone can do.
The key idea here
is something called pooled investments. It's a simple concept, really. Lots of investors, people like you and me, all pool our money together into one big fund. And that allows us to get a level of diversification and professional management that would be pretty much impossible to get on our own.
Two of the most common ways to do this are with mutual funds and ETFs. A mutual fund is a big basket of investments that gets priced once at the end of each day, and ETF, or an exchange-traded fund, is also a basket of assets, but it trades on a stock exchange all day long, just like a single stock. They're a bit different in how they work, but both are incredibly powerful tools for building a diversified portfolio with very little hassle.
So here's the bottom line on this. These tools have completely leveled the playing field. They give everyday investors access to the exact same principles of professional money management, diversification, low costs, and a disciplined strategy that used to be just for the super wealthy.
Okay, let's wrap all this up and think about what it really means for you, because this isn't just some abstract theory. This is your personal financial blueprint.
If you only remember one thing from our time today, let it be this. Managing your money is a process. It's a continuous cycle. It's all about planning your goals, building a portfolio that's designed to get you there, and then constantly monitoring and adjusting as your life changes.
And that leaves us with one last question for you to think about. I want you to take a hard look at your own savings and investments. Are they just a random pile of things you've bought over the years, or are they part of a deliberate plan? Is your portfolio actually built to get you to your future, or is it really just built for today? Something to think about. Thanks for tuning in.